John, it's May, so I mean, you can probably guess what we had 10 million questions on. We did see a little bit of a sell-off in April, but last week, markets started bouncing back up a little bit. But of course, everyone wants to know if it's sell in May and go away here again, or what else is going on.
So there is some statistical truth to sell in May and go away. If you took the Dow Jones Industrial Average since World War II, and you took all the gains from May to St. Leger's Day, you didn't make any money at all. And if you took all the gains from St. Leger's Day through May, 100% of your returns were happening then. Now, that's an average. Every year is different. I remember how everyone said, oh, September is the worst month of the year. You shouldn't own stocks in September. It was like 5 years ago. And September, the market was up 10% because of the 10% we did in September. So those things, they work, but you take it with a grain of salt. You put it in the back of your mind, it's another arrow in your quiver. But you can see the S&P has had a fantastic bounce. Let's stick to the long term. For those of you who are new to this show, we've been going now 4 years strong. Can you believe that, Trey? Never missed a month. And we've got markets that went sideways here from 1964 to 1982. 1982 marks out and rallies 1,150%. So if you're wondering what happened in 1982, it was a convergence of a lot of things, but the most important thing, we switched generations. The generation who worked for the prior 20 years, called the silent generation, sometimes even called the lost generation. They did nothing for 20 years. There's not enough of them. 1982, we get the baby boomers, 20% more people buy 20% more houses, 20% more cars, 20% more stocks. Stocks went up for almost 20 years. At this point, the S&P is trading with a 40 plus PE. And when we bottom out in 2003, we're down to a 4 PE. So from extreme exuberance to extreme overcorrection, we get another rally, another crash. But the real reason that this whole thing is happening is you just don't have enough buyers. We switch generations again, get me, Generation X, grandchildren of the Great Depression. There's not a lot of us. And from 2013 to present, we've got the millennials. They're the largest generation in world history. Of course, their parents being the baby boomers, my parents being the lost generation, the silent generation. And small generations have small generations of kids. Big generations have big generations of kids. There are 30% more millennials than there are Gen X. So the market since 2013, we're already up 350%. And this could last for as long as the millennials keep working. As long as there's millennials in the workforce and they're dominating and there's more people working than ever before. And as you know, unemployment is only 3%. There's a reason for that. Largest generation in the world demands lots of goods and services. There's not enough houses and cars for these people. And that's giving us the backdrop. And that's despite, let's look at the last 5 years, despite a worldwide global pandemic, despite shutting down the economy. I know, the Fed opened the balance sheet. But you have to think of this. We were at 15% unemployment right here, the summer of 2021. And things were coming apart around, not just here, but around the world. Things were looking pretty messy. The Fed then realized, oh, we've created inflation. They raised rates 10 times in 16 months. We have a 28% correction. And still the market has gone higher and the Fed has not changed policies. Think about that for a moment. So we've got no policy change and the market's already testing 5,200 again. Now, if we break it down for the last 5 years, we've spent the last 2 years going down and backfilling what we lost. We just got back to 4,800. So if you feel like you missed a whole lot, you didn't. Since January, the market had a run, broke out to new highs. We had a nice 6% pullback, and now we're getting a rally. And if we look at our relative strength, this rally is higher than when we were range bound in the last rally, which is higher than the rally when we were at the bottom trying to get out of the trough. And if we look at MACD, it's saying that we're through a correction. Now, the only thing that's going to drive MACD up is, of course, higher prices. You have to remember, MACD will be the latest to the party, but it'll be most frequently be right. So if you sold MACD here, back up a little bit, as soon as it crossed, you kind of sold at the bottom here, not such a great spot to be a seller. And of course, we'd had a decent bounce. Now we may be getting an ABC correction, meaning A wave down, the three red bars, B wave up, and if we get a C, it usually looks a lot like the A. So if it's going to happen, I wish it happened a lot sooner, but if we look at the daily chart, you can argue, okay, it looks like 1, 2, 3, 4, 5, 6, 7. Well, you had like a big messy pattern down here correcting, and now we're ripping the other way. Market just wants to go higher. Relative strength broke higher. MACD is giving you a positive cross. What can I say? It is what it is. It looks pretty good. Hey,
All
what do
right,
you
thanks for
think?
the update on the S&P, John. Yeah, I guess I want to hit the other two, or at least a couple of the other indexes here. We had a lot of interest in the Qs here with the Nasdaq, and maybe a small cap update too, if you want to check in on Russell as well.
Sure, I could even do a micro cap if you like, because by the way, the smaller the cap, the uglier it looks. little heads up on that. You can go straight down the line. The smaller the cap, the uglier they look. So there's the Qs. So if you wanted to take your S&P fully diversified portfolio and try to jack it up a bit, put some steroids in the mix, you would look at the Nasdaq. So instead of 500 stocks, you're only getting 100, more concentration. The top 10 names are 55% of the portfolio, not 32% of the portfolio like the S&P. By the way, that is not a bad thing. You want your best player scoring the most points. And if you're paying attention, you remember a couple of weeks ago, we did fundamentals versus technicals, and there really is no versus, right? There's fundamentals, there's technicals. A fundamental analyst once said to me, hey, when do you think you're going to be able to predict the future with those charts of yours? I said the same time you could predict the future with those quarterly balance sheets and income statements. They are yesterday's, right? They're not tomorrow's. And the analyst said, yeah, that's true. It's all the same. It's the same stuff. It's just a different point of view. Now, if you looked at the fundamentals, the margins for companies are really heavily skewed right now towards the big conglomerate names. Apple, Microsoft, Amazon, Google, Facebook, Tesla, they have massive margins. And that's what makes a business go. They've got big revenue, big earnings, big wide margins. And so getting a higher concentration has paid off. The NASDAQ, if you notice, it's kind of a subtle thing. I like to look at time and price. Notice this started rallying a little bit late in January. A little bit late to the party if you're looking at breaking from the old highs of 2022, 2021. But if you look around other parts of the market, there were some that were rallying earlier. Let's take a look at the Dow. Let's see what that looks like. And very similar picture. This was a little bit earlier to the party. This actually broke new highs in the middle of December, almost a full month ahead of the NASDAQ 100. Breaking new highs. Now, the name industrial is really nostalgic, so don't let that throw you. But the fact that this broke out a bit earlier is saying something. You have to look at the different indexes and see who's leading and who's lagging. The pullback was kind of mild, and its rally looks pretty good, just like every other index. So even though it's a price-weighted average from 1890, which no longer makes sense in today's world, United Healthcare is the largest position because it's $500 a share. And Apple has a little more than a third the size of that position because it's only priced at $108 a share. So it's less than 50% in the size of the Dow. It doesn't make sense. Apple's the second largest company in the world, followed by Microsoft. They're $2 trillion companies, and every other index that's market cap weighted, they are at the front of the list. So should we hit Microsoft and Apple while we're here?
Of course, we got a few questions on those here as always, John. So,
all right. So Microsoft broke all-time highs, kind of leveled off here. Now, there's two ways to correct, and I like one better than the other. This is a time correction. We're not really losing much ground, right? We're trading in this 5% range, 425 to 400, 425 to 400, 425, and we're rallying now towards 425 again. I like that better than a bunch of red bars headed down. This is a price correction, and price corrections lose you money. So I don't like those as much. I'd much rather a time correction. What that is telling me is we have an absence of sellers. However, that being said, I do not like that we touched new highs and my relative strength was shrinking. My MACD is rolling over. So we have to see, is this really the correction? And of course, Apple, all you needed was a massive buyback. And by the way, if you guys were here for the last call or two, I said, hey, Tim Cook is not the innovation guy. He was the chief financial officer. And in his genius, Steve Jobs, in his last act, said, you're going to be the new CEO. Notice, he didn't pick an innovation person. He didn't pick an engineer. He chose the chief financial officer because that would sustain his portfolio and his long-term, his estate, because of all of his Apple shares. He knew that Tim Cook could drive the stock price of Apple up. He's a brilliant financial engineer, but he's not the guy that's going to create the hottest new iPhone or figure out the living room, which was where we left off with Steve Jobs. He was trying to figure out, all right, how do I get in the living room? How do we figure out Apple TV? So this had a miraculous comeback from the 160s to the 180s in an overnight move with earnings. And the earnings were not hot, if anybody paid attention. The buyback was, and that was enough to drive the stock up. And it's financial engineering at its simplest. So want to do some sectors? I'll go from the winners to the losers.
Yeah, sounds good. We didn't get a lot of sector questions this week. I know energy and healthcare have been the ones popping up, here the most so far.
So one of the best places in the world to get this research, go to News and Research, go to Markets and Sectors, and click on the sectors page. I do it all the time. There's a roadmap that every business cycle will follow. Every 5 years, you will get, and if you look at the market, you will see it clearly. You will get, make this a 5-year, you will get an expansion, peak, recession, trough, followed by a new expansion that you hope is higher than the last expansion, and you have an uptrend. When the sectors rotate in 2021, the sectors leading the way were utilities, healthcare, and staples. Why? We were headed to a stock market recession, and we had one. I don't care about what the economist said. We had a stock market recession. We were down 28% high to low. We broke through my 3-year moving average. Nothing good happens under the 3-year moving average. But we managed to bounce back, and we touched it again. Again, that scary look. We broke through again, and yet we managed to break through again. So some of the worst news markets have had in the last 5 years, and we're breaking to new highs. It really is a miracle. But what's leading now? The stuff leading for 5 years continues to lead. We got communication services. Now, they're not breaking new highs, but you have to acknowledge we've gone from 45 to 95 in the last year and a half, 2 years. So this year, since January, we're up 50%. This is a percentage game, plain and simple. Followed by other names like tech continue to lead, XLK. But that pullback looks pretty nasty. We're seeing a bit of sector rotation in the last couple of months. Last 3 months, we're seeing tech only up 3-4%, where other sectors are starting to really ramp up, such as industrials. And again, it's a subtle move, but if you notice, January 15th, the market was breaking out, or tech was breaking out. December 15th, we had industrials breaking out. Remember, every chart is a study of two simple things, price and time. And price and time are equal. Did you ever have a boss say, hey, time is money? They were right. Time is money. And when you see something break out early, that's probably going to be your leadership in the next wave up. And sure enough, you had a fantastic run from XLI. We went from 110 on a base, and we rallied straight up to 120, 130. So a nice straight up 20 point uninterrupted, and then this nice clean little pullback, and we're getting another rally. This is as textbook as it gets, by the way. If industrials are going up, if you're building a Caterpillar truck, it's going to require a lot of materials. XLB is just trying to get started, attempted a breakout, little failure there. Just coming out of the gate. This is all new, so this is lagging. So this is stuff that might do well in the future, but it is absolutely lagging the rest of the market. Materials, the price of copper, price of gold, everything's starting to go. And of course, energy, which I know is up, but I don't know why in the US, we're kind of obsessed with energy. By the way, The U.S. now produces more energy than Saudi Arabia. We are the world's largest producer of energy, bar none. Period. End of story. Drop the mic. The largest producers of energy on the planet, but there's a lot of rhetoric that's anti-energy, which is bizarre because this is what makes the world go round currently until we figure out the next thing, which America is great at doing. So any other sectors that I left out? Oh, you want to go through the list? By the way, I would say XLU is a loser, but it is not. It is actually the strongest performing sector in the last 3 months, which scares the heck out of me. And again, this is a percentage game. Look at this rally. Where did this come from? Now, you could make the argument, and I will, if home builders are going up, XHB for home builders, if home builders are going up and ripping new highs, which they are, they're absolutely crushing it. Look at that chart. If home builders are going up, every time you put in a new home, you have to put in new cable, new water, new sewer, new electric, new gas. And when you do that, there are 5 new utilities all turned on at the same time. So as we're building new housing, which we're desperately trying to do, utilities are, they're getting dragged along. Whether they like it or not, they're going to go up. They don't grow organically, right? They only grow when home building happens, right? You can't create more utilities if nobody needs more utilities. If you have a decline in your population, you wouldn't need more utilities. But we've got the millennials, largest generation in world history, housing shortage throughout the entire United States. Utilities are getting a pop just on the backtails of riding the coattails, really, of what's happening in home building.
Hey, John, while we're on the topic, do you want to hit home building real quick? We had a few questions about that industry in particular.
Absolutely. So this is XHB. You should investigate your ETFs. They're all different ones. Like some of them have just home builders and some of them have like Stanley Furniture and all kinds of other stuff that goes in a home when they build it. So you really should take apart your ETFs to see what's inside. But you can see we had this long sideways move just like the market. And this broke out early in December. It did not wait for January like tech did. And we had a fantastic rally from there. Nice pullback and a new rally. And if we start taking apart the names, probably the strongest in the group is this Pulte Homes. I mean, just look at that chart. The breakout from this base has just been enormous, and not every home builder is equal. So if you're not using an ETF and using something that's market cap weighted, so this way you're getting more of the winners and less of the losers, you really have to do your homework because not every one of these is looking this good. Probably followed up by DHI. Not as big of a move, not as grandiose of a move. And the pullback, that pullback was awful there. So it does not look quite as strong as PHM, but go through your names, see what you have. And if you want to play the easier route is always use the ETF because then you're getting all the home builders. You don't have to figure out which one is the best. And also, I will say it again, the fact that my price is really getting close to my all-time highs and my relative strength is down here and my MACD already rolled negative, we could get another leg down. And we've got plenty of room before we get close to the 1 year or the 3 year moving average. These are trading extremely well. Anything else in the home building space? Or you want to go through that list? I promise we do that. I think we finished up markets and sectors in the first 20. That was pretty good. You want to rip through that entire list of questions you had?
Yeah, sure. And for this is the list of symbols that we got during registration, but I think most of those are also pushed live as well. So I've got the whole S&P 500 at your disposal from a question, John. You covered Apple here. Let's go to Triple M to get us going here.
And my apologies for all you folks that have been asking for this for the last few weeks. Every time we finish up, I'm like, why don't I bring this up? And here's why. It's depressing. So if you're looking for a bottom in something, there are telltale signs. And I don't know if this has it. What are the telltale signs, you may be asking? There are only 4 things a chart can do, which is why I love charts so much. And I'm only interested in one. And charts don't lie. So using my 5-year weekly time frame, my indicators will work better. So I can make all this work better for me than a lot of the stuff that people use and what's out there. So here's our decline. Obviously, we got lower lows, lower highs, pretty much a straight line down. And then we start to try to break through, but still going down. And eventually we stopped going down. Does that mean we're going up? No, we could be stuck here going sideways for an indeterminate amount of time. And again, there's only four things the chart can do. Why do I want to sit in this thing going sideways forever, waiting for something to happen, hoping for something to happen? Hope isn't a plan. And you can't argue, okay, hey, we broke closer to 100 here. And that's higher than what we've been in the last couple of years here. So you can make an argument that this is looking better. But with so many things reaching all-time highs and really rallying through the market and leading the market, I don't try to force the play, right? There's the thing, if you look at any sport, forcing the play. In soccer, somebody has the ball, you want to force the play. You want to force them to make a mistake, to miss pass. You want to put pressure on them. With this, it's the exact opposite. You don't want to force the play. Hey, we break above 100. We get a gap up, a run up of price, a big spike in volume. Those three things are what I am looking for. So let's look at the daily chart. Heck, let's do it with volume. So I'll have a very simplified version of the daily chart. And if you're looking at this, as if this is the chart you're looking at, I would argue this looks really good, right? You have a long sideways base. There's your gap up. You have a little bit of a run up. You have your big spike in volume, but I'm not getting the follow through where it's just gap and go. It's gap and something else. That rhymes with gap. And it's not looking so great. So as this is pulling back, you might have a low cost entry, enter at 94, put a stop below 90. You're risking 4%. You're trying to make 12. And if you get there, you might be early into this pivot and a change in trend. But my experience has been, once a stock goes down like this, it could spend a long amount of time going sideways. And this breakout looks pretty good. My indicator's not quite as strong. I mean, look, relative strength is not as great on that breakout, but clearly the price is higher. Relative strength is lower. MACD is lower. It's like I said, I'm not a firm believer, and I'd much rather ride the leadership than try to figure out something that's trying to pivot and turn around. There may be huge upside, buy low, sell high, but I can lose a lot of money while I'm waiting, or while it's not happening, or if it goes the other way. What else do we have? Sorry, I had to beat up my 3M friends. Sorry about that. But it's not a bad trade, but there's just so many things going up right now.
Maybe a good follow-up for this one too. Someone brought up the dividend yield on 3M, which is just over 6%. I mean, when you think about factoring in dividend yield, John, what would you tell someone there?
So there's dividend yield and dividend traps. So a dividend trap is you lose 6% in a week, and this is paying you 6% in a year, and you wind up becoming net negative. So I look at dividends, but as a bonus. If I can get dividends as a bonus, I'm happy to get a bonus. Pay me a bonus. Who doesn't like a bonus? But if you look at names like AT&T, okay, it pays you 6.5%. In the last 5 years, it lost you 50%. Let's see if I'm right on that. Yeah, stock used to be 32 and now it's 17. So you're down 50%, but hey, I got paid 6.5% to lose half my money. That's a zero-sum game. If anything, I probably lost. Verizon, same thing. A lot of these old school, and what's crazy, all these old school telecoms, people thought that 5G they were gonna knock it out of the park. They're the victims of 5G. I know that sounds crazy. It's very hard for them to pass on 5G to us, the consumer, because it is a very competitive market with small margins. When 5G happened, they had to go to places like American Tower Group, and they had to pay crazy money to upgrade all of their equipment to 5G. It cost them billions and billions of dollars that they have to amortize over 30 years. So for a while there, and we'll make this a 10-year chart, you could see who the winner was in 5G. It was names like this: American Tower Group, Crown Castle. This went from $80 to $280. If you look at Verizon at the same time, doesn't look the same. Now, of course, that's over with. Verizon was stuck in the 50s and 60s, and then it collapsed into the 30s. So this is not, they did not have 5G has not been a huge winner for Verizon and AT&T like people thought 3, 4, 5 years ago. It was really for the towers, and that day has passed. You only get those upgrades every, a couple of times in a generation. You get these massive upgrades in technology, and that's it. They increased all their leases. They gouged AT&T, Verizon, and T-Mobile, and now it's over. But they'll continue to get decent returns, but they're not going to grow because now they got to wait for 6G or 7G or whatever's coming down the pipe. Until that happens, by the way, now you know where to play. If there's a move to 6G or 7G, American Tower and Crown Castle will be places to look. It won't be the providers. The providers it will cost them money before they ever make any money. So what else do we want to talk about with dividends?
You ready? We're good on dividends. I think you nailed that one. Let's jump into some tech names. We've got a bunch on the list here. I'll start with. I'm not going to start with the semiconductors. We'll work our way into it. Let's do a CrowdStrike Holdings that came into registration, CRWD.
Yeah, and what's your favorite ETF in the space? Because I like to always use that as a base.
And just tech in general, like a XLK. You want like a broad or a specific software?
Specific to the guys that are in. I think Bug is one. The ETFs that for cybersecurity. So I like to start with those. So let me try Bug, see how that looks. And yeah, cybersecurity, Global X. So this is a global ETF for cybersecurity because other places in the world have to do this stuff too. It's not my favorite. There's probably a good iShares one. This is not a great rally here, and then it's fading, and we're nowhere near all-time highs. A lot of these guys have gotten annihilated. If you're in any of the smaller players like Cloudflare, this is a collapse. This was a very hot name when COVID was all the rage because everyone needed to increase their cybersecurity working from home. And, they had a really good play, and then that completely collapsed. The 800-pound gorilla in the space is
iHack as well, John, if you need it.
Yeah. What is it?
iHack, IHAK.
IHAK. Okay, we'll go back to that at the end. So we've got Palo Alto Networks. But look at this move. This is a move that is a changer of the trend. And when I see this and I see this massive volume, it's not me and you getting out. It's institutional size people getting out. And now we're getting this rally. It could be the first rally in an attempt to get back to where we were. But with that kind of selling pressure, let's break down to the daily chart. This is the only time I go to the daily chart is whenever I'm seeing a change in trend. When you go from uptrend directly into something else, that I pay attention to. So this was a $380 stock, and it kind of chopped around to 360, and then overnight, 260. It lost $100 of market cap overnight. It attempted to get some of it back, probably made it about a third of the way back up, and then collapsed again. That's not me and you selling the stock. This is institutions all getting out as quick as they could get to the exits. Now we're starting to see a little bit of a base. It's building. Same thing. Don't force the play. If this does not want to go up, it does not want to participate in the market, does not want to break all-time highs, you don't have to own it. So if you feel very passionate about the space, that the longevity, the other big name in the space is CrowdStrike. This looks a heck of a lot better, but I will say it again. On earnings, we had a gap up and gave it all back. Then we start to go sideways and we start to go down. So whatever's starting to happen for these companies, they're not getting the follow through you want to see. And I have no idea why this is so popular and people cannot stop talking about it on the interweb, but this stock is always a mess. So it had a nice gap up, gap and go, and then the very next day we collapse. I can't figure that out. It looks a lot like the cannabis stocks. I can't figure that out. So it looked really good for a minute, and it gave it all back. It's in the right direction long-term overall, but again, so many things breaking new highs. Why am I going to struggle with this and watch this sideways chop for so long? It's just not giving me enough return compared to some of the other names. What else we got? You want to go through some? I think we crushed cybersecurity. Oh, we want to do chips.
Yeah, let's check
I
the semiconductors. Yeah, we got a bunch of those. There was the two tickers that everyone said were iHack and Hack for cybersecurity.
Yeah, iHack. It's a long-term uptrend. You could be playing this as like your 5-year. Let's make a 5-year chart of it. I'm going to guess we're coming right back down. Yeah, so it failed to break new highs and it's pulling back. There's so many things above those new highs. I'd rather be playing in that space, but it's a pullback. It's rallying. This might be your handle to this very huge, long, oversized cup. So it's not a terrible play, but I'd have an entry. If this thing goes below 41, I'd have an exit. There's no reason you should lose more than 10% on this just to try to prove a point that you're right long term. And if it survives, hey, you got a great entry. If it doesn't survive, you move on to the next. And then we're going over to semis. Now, if you're looking for leadership, this is where you're going to find it. So it has been said that in the past, we had DJI. This is what determined what America was doing. Whatever the Dow Jones Industrial Average did is what America did. That's what we stood for. 30 big industrial companies. Now, the name industrials is nostalgic, but Dow theory still exists. Notice the Dow broke to new highs. Here we are. And here I'll draw a line in the sand there just to make it crystal clear. The Dow broke to new highs. That's a positive. To have confirmation for the economy in the bigger picture, transports should confirm the breakout to new highs and make us feel good about the economy. Ugh, look at that. Not only did it not break new highs, it retracted and went right back down closer to the lows. That's not a good look. So when you see transports giving you non-confirmation, you have to take that with a grain of salt. Now, why am I talking about this? Things like XLK, Tech, Communication Services, XLC. This is what America does, right? We build great cyber infrastructure. We're great at search. We're great at turning your car into a driving computer. We're great at software, hardware, gadgets. Everyone on the planet wants to own an iPhone. That's amazing that we've accomplished this. But how does it happen? Names like NVIDIA. NVIDIA is a breakaway company because they were in the right place at the right time for gaming. Then they were in the right place at the right time for Bitcoin and crypto. They had the right chips at the right time. Then they had the 5-nanometer chip years ahead of Intel having one. And they absolutely annihilated Intel. And so did AMD, by the way. Chart doesn't look anywhere near as good. And now we're moving into AI. And again, NVIDIA has the chips that everyone needs. They're trying to use the other chips. Qualcomm's got a good one. They're more expensive, but it seems like NVIDIA is kind of in the spot of leadership right now. So again, why force the play? If this thing refuses to go down, you wanted a pullback, you had one. We went from 950 to 760. That was your pullback. You had a 200-point pullback. I don't know if you're expecting a 500 or an 800-point pullback. You're probably not going to get one because there's going to be buyers. So when you see a decent 15, 20, 25% pullback in an uptrending stock that's leading the whole market, you have to take advantage of them when you get them. What else do we have? You want to go through any other names?
Let's
I can name
cover
like 5.
SMCI real quick too. That was another one that came up in the tech before we switch over.
Yeah,
Unless
so
you want to hit some more semis.
the question is this a head and shoulders top? That was the question. So just to explain, what is a head and shoulders top? It means that you'd have the head up here in the middle. You'd have a shoulder on the left, a shoulder on the right. The key to any of these patterns, I don't care if it's a double top, triple top, head and shoulders top, reverse it, head and shoulders bottom, do everything opposite, double bottom, triple bottom. The most important thing of all of them is the neckline. When that area of support or resistance breaks, that is the key moment in the chart. And for this, it looks like we've got a bottom, and notice the tails rip through it, but they never hold, around 715. If you want to be a little more technical and go right to the line, you could say it's 670 something, but really it's this area. This area around 715, it touched it once, big rally. Did a little pullback, did a crazy rally. Now, here's the thing about gaps and all the stuff you're seeing on this daily chart. Gaps begin and end the trend. You'll also see one in the middle. Look at the left. Let's talk about what's going on the left. I'm going to zoom in on the chunk of the chart where the chart really went ballistic. After years and years of sideways, the wider the base, the higher the space. This thing was stuck below 100 for years. Notice that gap up on earnings. That's a big gap. We're talking about a move from 100 right to 150 on earnings. And after we got that gap, and let me get rid of that so you can see the gap. After we had that gap and go for the day, we held a correction in time, not in price. Then you have your midway gap over here, and then the trend goes and goes and goes, and then you get this gap down, which is telling you the trend is over. And the trend was over for 2023, 2024, and then guess how we started the new trend? Gap up, run up in price. If I switch to volume, I'll bet anything there's going to be big volume there, and there goes that volume. Holy cow. So this thing is trading on average around, that's the average volume on that line. So we're trading somewhere around what? What's the volume on this? Moving around trying to see it. It's like a couple million shares. It's not a big, it's like 3-4 million shares. It's nothing great. And then all of a sudden in one day, we're getting volume of 4 point, well, that's the average volume. Let's see what that green day is. I was in the way. Yeah, we go to 23 million shares. The average volume before that was 4 million shares. So 5 times the normal. That's how you know this is the real deal. And we're breaking out of the base at the same time. And all we have is up, up, up. Then we start to get ridiculous. We gap up, like gap and go and gap and go. That's probably closer to the end of the trend. We collapse. We try again, collapse. We try yet again. We make it a little bit further to 1200, and then we gap down, try to rally, collapse, try to rally, collapse. It's looking kind of spotty here. It's got to hold 700. You could take all of this choppy mess as a correction. It's a correction that 1200 was too high, 750 is too small. It's correcting. It's got to hold that $700 area. If it doesn't hold 700, here's the tough thing. It could go to 500 and it would still be going up. It would still look good. This is a fairly new uptrend for the stock. The stock has not been uptrending forever. It had a rally in 23. It sat through the rest of 23. It had a big rally in 24. It gave up about 50% of it. I'm going to just draw it because, so the question, is it a head and shoulders? Only on one condition. It has to break the neckline. If it doesn't break the neckline, it's just a pullback. Because this what pullbacks will have lower lows and lower highs, and it will pull back. And if you notice, we're holding that 2/3, and sure enough, 2/3 is 650. If it gave up 2/3 of the move, right? If we call this the bottom and that's the move, because right before this is when it took off. As long as it holds this area of around 650, it's good. It's lost 2/3 of its move up. It's lost the majority of the move. Not looking great. But if it holds 650, it has the potential to go for another higher high. You have to remember, chips are the new transports. And there's tons of them. LRCX, fantastic looking chart. Let's look at the 5-year for that. So this jury's out on MSCI. On the daily, it could look like head and shoulders. It's got to hold the neckline. This is a head and shoulders bottom. There's the head and bottom. There's a shoulder on the left, a shoulder on the right, and you've got neckline, 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 we break out. Then you might look at this entire picture as a much longer head and shoulders. Here's your new neckline, your new resistance, around 7.25. We break out of that, and we rally it again. By the way, you take the difference from the head to the neckline, and that's the distance of your breakout. So if we were taking this as $300 a share with a rally up to 7.25, that's 425 points. Add 425 points to 7.25, and what do you get? 725. I'm guessing we're at like 1,175, and we already hit 1,000. So if this is going to truly do what Head and Shoulders as a theory does, it's going to rally the distance from the head to the neckline, we got a ways to go, right? This is the extension of the rally on the upside. We've done more than half of it, but we still have another rally to go here where we should break even higher. We'll see. We'll see if this holds on. This is holding on pretty well compared to some other names. I don't know what's going on at AMD, but man, it doesn't look as bad as ADM, but AMD looks pretty bad. That's a pretty nasty sell-off. Any other chips? Anybody else looking for other names? There's so many.
I think we got the chips pretty well, John. We got about 15 minutes left. We did get kind of a general trading question. It's actually our top voted right now. Might be interesting to go through as we look at some other names. But just the question was, could John review how he establishes his entry and exit prices on a trade?
Absolutely. And I'll give you a difficult one. Let's go with Eli Lilly, because I know that was also in the queue. That was a question that people were asking about. And again, this is another monster uptrend. If you're looking for leadership in the pharma space, and I know somebody asked the question about Merck, so I'll take a quick chart at Merck, and then we'll do the entry on Lilly. This is a higher high, higher low, nice clean rally. It is getting really far from that daily, that 1 year and 3 year moving average. But this thing has been touching the 1 year moving average for years. Those were your pullbacks to be bought. But let's take a quick peek at Merck, because I didn't want to, I'm trying to do like no name left behind. I looked at the list. I'm trying to hit everything. So this looks good. It's a good looking uptrend. It just does not look as good as Lilly. Lilly and NVIDIA are two of the leadership, and NVIDIA is now the third largest company in the S&P. Eli Lilly is the eighth largest company. It's one of the only non-tech names, along with Berkshire Hathaway, in the top 10 of the S&P. Monster companies. So let's take a look at Lilly, and how would I risk manage this? And the difficult thing is, how do you buy something that's in this feverishly fast uptrend? Well, you had your opportunity right here, right on that pullback. And let's face it, we missed it. So we may have to buy it on the run now that we're getting a new rally. There are other drug companies starting to get approvals for weight loss drugs, Amgen being one of them. And Amgen had a nice 13% pop the other day. As you can see, it's giving a chunk of it back, because getting some approvals is not having the drug yet. Lilly and Novo Nordisk have a huge head start on everyone else with this. So you could look at this as we're in a sideways move. You're waiting for the breakout of 800. You're kind of in the middle of the range. Not a great entry, but we'll deal with what we got. So let's say I would probably stage this and buy it at two different levels. I would buy it at the market to have a toe in the water. And if I were lucky enough to have it go against me and it went below it went to 750, lost 25 points, I'd buy it again. I would not want to see it break 7.25, just as an example. I might be able to buy it in the sixes a lot cheaper. Why would I want to stick around? So I go to trade and orders. I go over here to Trade Armor. Now, Trade Armor will take away your keystroke errors. No more keystroke errors. That's kind of nice. Also, you can trade directly off the chart. Lastly, you can do multiple trades and manage all your risk. So I click on trade. I'm going to say buy triggers a bracket. So I'm going to get rid of this support and resistance because it's too noisy. There we are. So notice it starts with a market order. So I might start with this. So if I'm willing to buy at 7.25, I just can't go below 7.25-ish, 7.18. I don't want to break below that low. If I break this low, something's wrong. Now, this is a hard spot because I'm risking 7.5%. I can't make 1% and risk 7.5%. I'm sure to lose money over time. I've got to make at least 22% on my upside. So we're talking about getting to maybe 980 a share. Yeah, a little too high. Maybe try 950. Here we go. I'm in at the market to buy. If we break this sideways trend and we're going to go lower, I don't want to be there. By the way, the market makers may just fake me out here, whipsaw me, and go higher. It happens. There is no perfection in this. I'm buying it high, so I've got to acknowledge my risk. They could whipsaw me. So if I'm buying at the market, I've got my stop below all the prior lows in the last quarter, and I've got my target 3 times higher than my loss. I'm literally off the chart at $950 a share. Now that's entry number one. It be my smallest. Let's pretend we're looking to buy 100 shares. This might be only 30 shares that I'm looking to buy. And if I can get a pull back to 7.25, which isn't asking that much, well, maybe it is, maybe 730. Yeah, maybe if we could just fill this gap, right? We gapped up, maybe it wants to fill that gap. If we can get to 743, notice I'm risking 3.5% to make 27+%. I've got my new entry, I've got my new stop in this order. Maybe this is going to be 50 shares. And then I accept, hey, I may have to buy another 20 shares. If this thing breaks above 800, I'm going to have to go chase it. I can do a buy stop to buy the last 20 shares at 800. The thing is, I'm managing a wild, feral beast, right? The market is wild. It's all over the place. And to try to put rules around it is difficult. Having trade armor and using these tools, this is the closest that we have. I've got my entry, I've got my stop, I've got my target, and I've got a plan. Now, here's how fortunes are made in the stock market. First, you got to overcome taking losses. Losses are going to happen. You're going to have bad decisions all the time. Make them all the time. You have to accept that they're wrong and move on. Try not to be emotional about it. The less emotional you are, the better. The more you're looking at math and science, the better. But what if I'm right? What if I buy it here and we're getting awfully close to 950 and I'm closing in on a 27% return? That's pretty sweet. You have to remember, Eli Lilly, the earnings haven't even reflected Zepbound yet. They're just getting started. They're buying other companies just to get the manufacturing base so they can. Their biggest problem is they don't have enough vials for the syringes. They don't have enough production to meet the demand. That's a fantastic problem to have, by the way. So if we're getting dangerously close to 950, I don't have to get out, but I do have to manage the position. So what would I do? I would then raise my stop to somewhere in this range. Remember, this acted as resistance for months. We're about 4 or 5 months in, that's been resistance around that $790, $800 spot. It shouldn't go below 770, let's say. So I'm locking in at least the 3.5% profit on the downside. Instead of a 950 target, I'm going to move that up. Let's go for another $100 per share. So my 27% gain, I'm now going for a 41% gain. And this is the key. If you can create a system where you're right 50 to 60% of the time, by the way, 60% of the time you can go in like the Traders All-Time Hall of Fame. 60% of the time is unbelievable. But if you could be right slightly more than you're wrong, that's a plus. Now, if I could take my winners to the moon and I quickly get out of my losers, that's really where the game is played. Make your losses small or not at all, and then make your targets. If a stock wants to run if this wants to run another 1,000 points, I don't want to get out. I want to try to get the next 1,000 points. Right? If you've been in this for a while, congratulations, anybody who owns this. If you've already taken the ride from 300 to 800, you might be in the first inning of what might be a 9-inning game. Or if we're looking at 5-year business cycle, you might be in the first year of what could be another great 2 more years. So why would I get out? If this is going to be a blockbuster drug, think of how Pfizer did on a drug that affects a very, very small segment of the population. How many people in America could afford to lose 20 pounds? Raise your hand. I'm one. And how many people are going to go on this drug to do it? Probably a lot of people. So the audience for this is way bigger than any audience for any other drug we've ever seen. And that's the key. And they've got a 5-year patent, right? I think they got 5 years to go on this where they're going to have their patent. So I would check to see when their patent runs out, because 3/4 of the way through this, stock will probably run out too, unless they keep changing the formula, making it better and better, which happens. We've seen Regeneron do that with their blockbuster drug for, what is it, REGN? And I forget what it's not glaucoma. I forget the problem. So they have an eye drug that you actually have to get the shot in your eye to keep your eye inflated so you don't lose your sight. and it's helped millions of people keep their sight in their older age. So this is again, it's a small segment, but it's very important to those people that are on that, and they're not going to not take it, right? They're going to make sure that they get the drug. And the chart, they've broken out, and they're doing a nice, decent return. But again, it's not the blockbuster number of people that want to go on it like what Lilly and NBO have. Yeah, there's Lilly, there's Novo Nordisk. I think they employ like half the Danish people are employed by Novo Nordisk. So it's a big deal. Any other questions? You have some more names because we got 5 more minutes. Let's do a little lightning round.
Lightning round? All right.
How many names can we do? And we'll quickly say up, down, or sideways.
I did the math, John. If we can cover one every 7 seconds, we can get the whole S&P 500 done in an hour. So maybe for next one.
All right, let's do it.
Let's start with Costco. That was on our registration and live list here.
Who likes Costco? Put in the thing if you like Costco. How do you not like Costco? They've got everything at a decent price. I mean, even go in there, wind up buying flowers because you're like, yeah, $20 for flowers, all right. I don't know how it is. I go in there for milk, bread, and eggs, and it's $500. I don't know how that happens, but it happens.
Every time.
Costco, every time. It gave you a nice 60, 70 point pullback. That's 10%. And here we are rallying again with the rest of the market. By the way, Costco is in the top 10 of the NASDAQ 100. What? Yes, the tech-heavy NASDAQ has 10 sectors, doesn't have 11, cannot have banks in it. That's some weird inside baseball. But Costco is the consumer staple, is in the top 10 of the not the S&P, but the NASDAQ 100. It's number 10. Anything else? What do we got? It's definitely going up. It's up and to the right. What's not to like? MACD is about to cross positive again. It's re-rallying again. If you missed the pullback, you're on to the next rally already.
Yeah, top voted from the live right now is Berkshire B.
BRKB is up and to the right. It is one of the leaders in the finance space. It's up and to the right. It's clear. It's leadership. By the way, they are more of an insurance company than anything else. What is the insurance company? It's slipping my mind. IA something for all the insurance companies as an ETF. It's an iShares. IAK. Got it. Mental Rolodex kicked in. IAK looks fantastic. Looks just like Berkshire Hathaway all-time highs. I don't like that sell-off bar. That scares the heckers out of me because this rally makes me think that, okay, this rally, after this all-time high, seeing that kind of selling volume, that's a spooker. But for the last 2 years, how many people have felt inflation? Where you're probably feeling it the most? House insurance, car insurance. You go up 20% in that, that's a game changer in your bottom line in your household. I don't care if I'm paying an extra nickel for eggs. I don't care about even a dollar for eggs went to $2. I don't care. But when my home insurance goes up 20% and my car insurance goes up 20%, these guys are killing it. And I can name 100 names that you probably aren't thinking about. Allstate. I mean, the charts are just, they look like tech stocks. I mean, look at these breakouts. They look phenomenal. What else we got? Berkshire Hathaway B, JP Morgan. Is that on the list?
That's also that was on the list great. Too. Yep.
Goldman Sachs also doing great. They're all up and to the right. They're all breaking out. By the way, you haven't missed much. These things haven't gone up since 2021, right? 2021, they topped out, and we just broke out to new highs. You got a decent pullback. Nothing wrong with any of these charts. Insurance scares me because I don't like, when I see that volume, by the way, everything your mom and grandmom told you about life, that is true. Be tough, stick it out, don't give up. All that stuff is 100% true. It's not true for the markets. Be a coward, run away, live to fight another day. Do the exact opposite that everyone ever told you to do when it comes to investing. That's why investing is so hard. It's against our nature as people, especially if we're tenacious and we're successful people. We want the market to bend to our will. It doesn't. You have to just fold. A good poker player folds 60% of the time. That's good poker. 60 to 70% of the time, you're just folding. You're spending most of the game folding. And every once in a while, you get a fantastic hand, you got to crush somebody. And then you can bluff because then they think you have the cards. But if you notice, Goldman Sachs just peaked and just broke out. You haven't missed anything yet. Everything's just getting started for financials. XLF is just getting started. Industrial is just getting started. Materials and energy, they should be further in the background. Don't think about those yet. Those are late stage ralliers. When those things go ballistic, the market's next mover is recession, so be cautious. But financials, they don't have to lead, they have to participate. They're participating. Here we are at all-time highs. This area here, we didn't break out of since the year 2007. We broke out in 2021, we retested, and we're right back where we were in 2021, right against all-time highs, just getting poised to go. Some of the problem, though, will be the little banks. The KRE is holding it back. This does not look as good. We collapsed 2 years ago, and we have yet to come back. That's a collapse. We snapped through that 3-year moving average like a twig, and we went straight down on volume. That's institutional volume. I don't see any institutions buying this yet. And that's the holdback on financials. The big financials, like I said, in this market right now, monopolies are good, bigger is better. How come nobody talks about Amazon? Amazon right up against all-time highs. Google broke all-time highs. These are things that are really leading the market right now. Amazon, we're right up against it. After years, 4 years of nothing, we're finally going up on Amazon. Google, and by the way, I was a hater because I didn't like the gap down on Google, but we filled the gap and we went the other way. And I might have to switch to my daily chart to show what I'm talking about. Come on, update.
Google was the next on the list, John. We were almost there. We're
almost there. Yeah, so I want to show ways on the daily chart. When this thing gapped down, it attempted to rally and it started to fail. I go right off the board. I'm done. I'm out. But then we did the exact total opposite at the same area. We gap up in the same area, and then we follow through with volume, and the institutions are back. And we get another big follow-through day over here. And now here we are ripping all-time highs. So anyone who thinks that AI is going to happen and Google's not going to participate, they're going to have a tough time figuring that out. And even names like IBM, which in this last round, not so good. These guys should own AI. This is the only thing that they've really got. They've had AI for decades. They've had games, beating chess masters 20 years ago. I don't know why this chart doesn't look better. It was for a while there. If you look at the 5-year chart, this was a phenomenal move to the upside, and we've had a few of those. By the way, you guys want to see some of the ones that I'm looking at? I was looking at this. Phenomenal move, big pullback. It's got to hold this area. It doesn't hold this area, it goes on the scrap heap of bad decisions. But look at this base. We went sideways for 4 or 5 years, then we rip. We just totally break out to the upside. Nice gap and go here, nice volume. And I see some institutional to the downside, and it gives me there's no reason not to chop the position in half or completely take it away and wait for the next rally. Wait until it sorts itself out. I don't have to sit there and fight through it. Let's see if I can get a couple of quick names in here. Things that you might not be looking at. Ralph Lauren, after years of nothing, all of a sudden had a massive rally. Look at this massive long sideways. And here we are. If this isn't the biggest, wouldn't even be a cup and handle. You would consider this a saucer, right? We've got this saucer shape that's been taking place now for 10 years. How bananas is that? For 10 years, this thing did nothing but go sideways in this kind of saucer shape. And now the saucer is breaking out after all these years. We're now breaking out to new highs. Now, if we get above 190, it's all-time highs, lights out. This stock has not done that in its lifetime. This has been a stock that's been mucky and stuck. TPR was right there. Their merger failed. The Justice Department stops every merger. They get paid tens of millions of dollars in fines, and then somehow or another the mergers happen, just like with Activision, Microsoft. So although they're blocking it, they may still go forward and try to take over Michael Kors. By the way, this is the folks at Coach. They're trying to take over Michael Kors for the affordable luxury space, and they want to compete with Louis Vuitton on a national level. They want to have 100 different brands under their umbrella. Scale up, lower production costs, fire all the duplication and effort, and you have a much more profitable company in theory. Now, can they pull it together? Again, this is not a pretty looking chart for the the lifetime of owning that chart. And let's look at just the last 5 years at TPR. You could see it really looked like it was going, and then the Justice Department and completely deflated their balloon. But I don't see an institutional level sell-off. Here I do. But this next rally, it looked like it was really going to get there, and here we are. Now it's anybody's ball game. We're in the middle of the range. If they can't get it together, we collapse. If they get it together, you may see something that this thing has never done. It might actually go up. But there's so many things going up, that from the chip sector to the home builders. If I could say any one thing, don't fight the trend. If you want to place a trade, okay. These names, these luxury names like the Ralph Lauren's and the TPRs, it's a trade. If it doesn't work, you get stopped out. Okay, you move on. You gave it a shot. You were looking at a huge return if you can get out of these long sideways. This has already done the work for you. It is clear this wants to lead. It is clear that this wants to lead. Home builders, semis, if you want to let them lead, there's no reason to fight the trend. The trend is your friend. Trey, I think I'm losing my internet connection. How am I doing?
Yeah, we're losing you a little bit. We're a couple minutes past though, so we're at that time anyway. John, while you're working on that, I'll just throw a couple reminders before we close it out. If you haven't signed up for the June, what are the charts telling us? You can click that button below the viewing screen, sign up. We'd love to see you back there, as we'll try and get through more tickers, or as many as we can in that one. Also, John and his colleagues across the country, our regional brokerage consultants, are here to help you out. Using Fidelity's platforms and tools and more. Of course, if you're interested, John, how do they get in touch with a regional brokerage consultant like yourself?
So on a personal note, a lot of people reached out on LinkedIn to hit me up as a connection. I will absolutely connect, but I cannot answer questions on LinkedIn. So happy to connect, though. Happy to be friends. If I ever see a chart out there or something interesting, I post it. But I will say, go to your local branch. There's a regional brokerage consultant in every branch in the country. We're actually all here right now in Chicago, and we will all be back to work on Friday. So if you want to talk about Active Trader Pro, which you see running here, you want to talk about using Trade Armor and how you could start to get a handle and a business plan around your investing, Trade Armor is going to be, using technology will be a vital step in doing that. So I highly recommend connect with your regional brokerage consultant. Now, if you have outside assets, even better. We'd love to have more of your assets at Fidelity. That's really what pays the bills around here. I only get paid on two metrics. How many appointments did you do and how much in assets came in? So I'm very interested with people with outside assets. So if you're in the Westchester or New Jersey branches, reach out to your local branch. You could ask for me and we could always set up an appointment.
All right, perfect. With that, we'll close it up. I want to thank everyone for joining us. Thank you for all the great questions that you sent in along the way. And John, thank you. We know you had to work around a pretty crazy travel schedule to get here for today's show. No sleep, taking the early flight, getting into the hotel. We appreciate all of that here for us so we can keep the show as is. But with that, we'll close it up from here. Thanks again, and we'll look forward to the next one. Bye-bye.
Thank you, guys. Have a great week. See you next month.